Hey guys, Adam Rose, Vice President and Senior Loan Officer of Western Ohio Mortgage here in Sydney, Ohio. Today's another episode of the Mortgage Guy Podcast. We're going to be a little bit more brief today, and I apologize for missing a couple of weeks there. Life's been a little crazy, but we're back at it, and a pretty big announcement on the mortgage insurance front and tax situation. But other market updates, which we'll get to that here in a minute. There's a lot of talk about trying to fix the inventory issue, throwing federal monies at it. I don't know how that's going to work because a lot of times when you do that, they're going after very, very large projects, more of apartment complexes, not the single-family, multifamily homes like the 1 to 4 units. So more news to come on that, but there's a lot of talk in Congress on how to fix that. But more news to come. We'll keep you posted. But anyways, the reason I wanted to hop on here today is because I wanted to talk about the MI premium tax deduction. So mortgage insurance, right? PMI, that's how you might know it, or MIP, mortgage insurance premiums. That is attached, and we've talked about this. You need 20% down to avoid it, or maybe a VA loan, which doesn't have the monthly mortgage insurance premiums. But we also talk about minimizing out-of-pocket expenses in this high-rate environment because, when you really look at the numbers, the PMI payments really aren't that bad, considering the fact that you might have an $80 a month mortgage insurance premium or a $20 a month mortgage insurance premium, but to avoid it, you might have to throw $40,000 out of pocket. Does it make sense to save that just to get rid of mortgage insurance? A lot of times it doesn't make sense. Well, it makes even more sense now to have it because there used to be an MI premium tax deduction, and it was introduced back in 2007. It was in place for a very long time. It ended sometime in 2021. And it just came back. They reinstated it, and it translates to some pretty significant savings when you go file your tax return. So there was some data on here from Radian Mortgage Insurance Company. To quote their article here, the average deduction amount on the taxes were $1,454 per qualified taxpayer. For some, it could be higher, of course. And in tax year 2021, qualified homeowners received an average deduction back in 21 of $2,364 off their taxes. And 65% of homeowners do have PMI. So let's run through that real fast, all right, so you kind of have an idea. So USDA, and this goes for all loans, right? Conventional, USDA, FHA, okay? You can deduct the mortgage insurance premiums, government-backed and private, right? Fannie and Freddie. So that's the plus. It's not just conventional financing. So if you're trying to figure out monthly payments, what makes sense? Do we do 5%, 10%, 15%, whatever it is? Now we have this factor of, all right, well, here's your total out-of-pocket expense to save X amount of dollars. But now if we decrease our down payment, we add the PMI back in, you also have this potential tax deduction and savings as well, which will net you X amount of dollars in a refund, right? So it's another thing that we got to look at. So that's fantastic news, but let's go program by program. So USDA, their monthly mortgage insurance premiums are 0.35%. If you're buying a $100,000 house, it ends up being like $27 or $28 a month. FHAs with the minimum down payment is 3.5% down. If you go over 5% down, it's going to go to 0.5%. All right, so if you do FHA on a $100,000 loan, minimum down payment, it's probably going to be around $48-$50 per month. And then, so that translates into like $600 a year tax deduction. And then, again, it just depends on your loan amount, right? Because it's a percentage. The bigger the loan amount, the higher the mortgage insurance premium is. And the conventional ranges, because conventional financing, it depends on your down payment. It's all risk-based. Depends on down payment, loan to value, right? Which is your down payment. Your credit score, things like that, to consider your risk-based type of program, right? Are you a first-time home buyer? Are we doing a 3% down, home ready, home possible? So a lot of things factor into how much coverage you need on the mortgage insurance on the conventional side. It's not as black and white as the government lending programs, but nonetheless, it can be quite a big savings and something to look at moving forward. When you are making this purchase is something to consider if you are one of those no PMI ever type of people, which we run into, right? They think that that's the only way you can go is 20% down. Not that it's a lack of knowledge that they can't put less down. It's just the way they're built. It's the way they've always been taught from family. And they just push the envelope. So now it may not make any sense to do it. Maybe you do a 15% down and you save yourself, $10,000 or $15,000 out of pocket and then you get an extra tax deduction for the next 3 or 4 years. So it's a good option. So the role of private mortgage insurance, real fast. I'm just going to continue here on Radian's article here. Is it's a catalyst, right? So it's allowing buyers to purchase homes with as little as 3% down, and it enables you to begin building some equity sooner rather than later going into the housing market. And now with the tax deduction in place, it makes it significantly more advantageous to do that. So this is going to spur the market quite a bit. It might spur a little bit of economic growth with some additional tax deductions going through. And I think it's fantastic. Now, I don't know the answer on whether or not you have to itemize to get the deduction. I am not a CPA. I did not consult a CPA before I came on here just to announce this because it just came out. So it's something to look into. Because if you itemize, I know I couldn't do it, but if you itemize, you can deduct your mortgage interest, right, on your taxes, and then now you have the PMI additive. So I mean, if you're able to itemize, you can combine both of those together. I mean, you might look at $6,000 to $10,000 in deductions for the year. That's impressive, right? I mean, that's just one additional reason why homeownership makes more sense than if you're out there renting right now. And I know I'll get some hate for that. We'll rent so much cheaper. Well, is it? No, I don't think it is. So it just depends where you're at. But it's just one of those extra additives. I think it's going to help buyers go back into the market. Again, not the only reason, of course. Homeownership gives you a sense of pride, responsibility. It's a great way to build wealth. It's the number one wealth builder in the country. So if you're ever on the fence and just didn't understand some of the other backside benefits, well, here's an extra one, right? Even if you go no money down USDA, you're still going to get a tax deduction from the PMI. But with this being new, you may want to consult a CPA or your local tax professional on whether there's a standard deduction or if you have to itemize and what your options are there before you just go to the bank with my advice here in this update. So that's all I got for you guys this week. I hope that was helpful. But spread the news. This is a great thing, and I think it's going to be going into effect now or very, very soon. And so you should be able to do that on your 25 taxes in the upcoming new year. So remember, guys, subscribe on YouTube. Check us out on Apple Podcasts and Spotify, and we'll see you all next week.